What's going on, guys? Welcome back to another video. Today we're going to talk about what Roth IRA is, why it's important, and why you should start one as soon as you can if you are financially able to do so. When I was younger, I always told myself I'll start it next year, and I wasted so much time and money because throughout those years my money could have been compounding and the value of my portfolio would have been much bigger than it is today. But it is what it is. Everybody learns at different times and everything happens for a reason. So I'm making this video for you guys, so if you are on that younger side, and even if you're not on the younger side, you can still start it and make sure you are ahead in life and you are setting yourself up for retirement, because retirement is very important. If people don't set up for retirement, I've seen a lot of situations where people are simply not ready to retire. They are of age to retire, but they're just financially not stable to where they can enjoy the last 10, 20 years of their life. And it's a very sad situation because you don't want to be in that place and you don't want to work till you die. And you also don't want to put your kids in a place where they have to take care of you, or you're kind of being a burden to your children. So it's very important that you set yourself up for the future. And it's also very important that you do it correctly. So just a quick reminder that this video is not a financial advice, and let's dive right into the video on what Roth IRA is. Your future tax-free, unlocking long-term wealth with a Roth IRA, the retirement account that works harder so that you don't have to. What is a Roth IRA and what does it stand for? A Roth individual retirement account, obviously IRA stands for individual retirement account, gives you a chance to grow your money over time by investing already taxed dollars into different things, which we will dive into in a few minutes here. But what does already taxed dollars mean? So let's say you get a paycheck of $500 and you decide you're going to take out $100 and invest it into a Roth IRA. That means your money's already been taxed, federal tax, income tax, whatever. All the taxes have been taken out, and that's money going into your Roth IRA. That means that money has been already taxed. It's simple as that. With a Roth IRA, you pay tax today on the money you contribute to your account. You can invest that money in a wide range of investments, including stocks, mutual funds, and ETFs, which will break down. Withdrawals, including investment earnings, are federal tax-free when you reach age of 59 and a half and the account has been open at least 5 years. Unfortunately, your ability to contribute to a Roth IRA phases out at a higher income level. So there is limits that we'll also talk about. If you are past a certain salary limit, you will not be able to contribute to a Roth IRA. Obviously, the whole point of a Roth IRA is to not have any taxes on your investments by the time you get to retirement age. And that is beautiful. I mean, who would not like that? Why start now? The power of compounding. Obviously, the earlier you start, the bigger the snowball effect is going to be on your portfolio value. Time is your greatest asset. The earlier you start, the more powerfully compound interest works in your favor. Returns earning more returns in a tax-free environment. So let's say you're putting $100 at a 7% annual growth. After 1 year, your $100 becomes $107. After 10 years, your $100 becomes $197, nearly double your original investment. And after 30 years, your investment becomes $761 and over 7x growth, all tax-free in a Roth IRA. And that's why we want to have those Roth IRAs and why we want to start as early as we can. What does your money do? Think of your Roth IRA as a container, not an investment itself. What you place inside the container determines how your money grows. Common investment choices include stocks, bonds, mutual funds, and most powerfully, exchange-traded funds, which are called ETFs. The Roth IRA wrapper shelters every game from a taxman. Now, this is very important because you don't want to have high-risk stocks in your investment portfolio, because if that stock goes to zero, obviously you're going to take a hit. The most popular product that people have in their portfolios is the ETFs, and I'll explain you guys why, and I'll also explain you what ETFs are, because I know exchange-traded funds kind of doesn't really make sense. But stocks, if you are going to put stocks in your portfolio, you have to make sure they could be stocks that can pay dividends, and they're also stocks that have been around for years, right? Like Apple, Microsoft, Google, JP Morgan, Coca-Cola, stocks like that. You don't want to put very high volatile stocks in there because obviously we want to be sheltered from market volatility. What are the actual ETFs and how do we even understand them? So ETFs are baskets holding many investments, stocks, bonds, or both, trading on exchanges just like individual shares. They're usually usually low cost. ETFs typically carry lower expense ratios than actively managed mutual funds. More of your money stays working. Now, diversification instantly own a slice of hundreds of companies, dramatically reducing the risk of a single stock collapsing. Now, I know some of you guys are probably wondering what the S&P 500 ETF is, because if you're brand new to the market, I know you have some hard time understanding, but the S&P 500 ETF mirrors the performance of the S&P 500 index, giving you the exposure to 500 of the biggest companies in the US economy in a single simple investment. So if you're buying the S&P 500 stock, you're buying one share of 500 of the biggest American companies, right? So it's much easier than picking one company. It's the go-to choice for Roth IRA investors for good reason: broad diversification, minimal fees, and decades of market-beating historical performance, which is super true. Investing in an S&P 500 ETF means betting on the US economy as a whole, proving long-term strategy. And that is super true. As I said, 500 largest US companies, broad market diversification, low expense ratios, and long-term historical growth. Market performance over time. Despite short-term volatility, stock markets have delivered consistent long-term growth. The S&P 500, tracking 500 of America's largest companies, has the average 10 to 12% annual returns over many decades. And inside a Roth IRA, every penny of that growth is yours to keep. No capital gains tax, no income tax on withdrawals, just compounding returns, sheltered for life. And that is probably the best part of it. As I said, that's the whole point of a Roth IRA. Now, income and withdrawal rules. I'm going to tell you guys the income rules, because if you are a high earner, most likely you will not be able to get a Roth IRA. And we're going to go over the withdrawal exceptions so that you guys know and are aware before you start any investing. Now, the limits go as follows. If you are single, head of household, or married filing separately, under $153,000, you can make a full contribution. And if you are between $153,000 and $168,000, you can make partial contributions. And if you are past $168,000, unfortunately, you cannot contribute to a Roth IRA directly, but there is some backdoor IRAs that you can probably look into some videos on YouTube. And if you are married filing jointly, under $242,000, you can make full contribution. $252,000 or more, you cannot contribute directly. As I said, if you start, it's best to keep your money until retirement age, but there is some certain exceptions that you can withdraw your money tax penalty free, so that you don't have to pay that 10% tax penalty. Now, those situations are a first-time home purchase up to $10,000, a birth or adoption expense up to $5,000, a qualified education expense, a death, disability, or terminal illness, for health insurance if you are unemployed, or some medical expenses. And you want to do some more research if you have a situation that you need to withdraw, because obviously those are the name of the exceptions. I'm sure all of them have their own fine print. Your tax-free future starts today. The best time to open a Roth IRA was yesterday. The second best time is now. What you want to do is you want to open an account, choose a reputable brokerage. I go with Fidelity. Fidelity is probably one of the best. It's super simple to use, and you can have any product that you want. You can fund it regularly, set up monthly contributions, weekly, daily, whatever you really want. Invest smart, buy low-cost S&P 500 ETFs, because you don't want to bet against the American economy. Let the compounding do its thing. Hold long-term for tax-free growth, because obviously more time goes by, the bigger that snowball effect is going to be. Every month you wait is compounding. You will never get back. Start small, stay consistent, and let time and tax-free growth build your future. This is very true, guys. The earlier you start, the more compounding you're going to have, and the bigger your portfolio value is going to be, and you don't want to miss out on that. So I hope you guys enjoyed the video. If you did, make sure you go down, hit the like button, hit the subscribe button, and I will see you guys in the next video.